All right, good morning everyone. Welcome to the live stream. Opening bell is going to be hitting us in about 23 seconds. If you follow Traders Espresso, the blog, the written blog is posted. The video blog is recorded but processing, so I will let you know when that's accessible. 3, 2, 1, ding, 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 ding. So the futures overnight are soft. I think I mentioned that. VIX is elevated. Just looking overall, like, NASDAQ being down. So Dow's down 60 bips, NDX down almost 60 bips, Composite down 53 bips, SPX down almost 60, the RUT's down 53, the Treasury Index is down 46, so bond prices down means yields are up. Okay, the dollar index has been down, it's down 52 bips, which is interesting because it has been it was up 6 days consecutively last week. I'm going to follow the ES today, which is the mini S&P futures. Right now they're kind of rallying strongly. As you can see, this green bar shooting up above the 243 period MA. I know I have funky MAs. I have multiple, or powers of 3, so 3, 9, 27, 81, and 243. That's not what I wanted. I wanted to look at the... That's a 243 period MA. So I generally don't like, when it comes to the futures, I don't like to trade the first 15 minutes or the last 15 minutes of the day. It doesn't mean I haven't done it. I have. I've made big money and I've lost big money. So just the volatility is pretty insane. So I like to give, kind of give it 5 minutes at least to kind of find its footing, so to speak, figure out what it wants to do. Right now it looks like it wants to go higher. So on a 1 minute chart, we've got bullish stochastics. The 4 minute chart as well. The 15 minute chart is moving to a bullish stochastic crossover. So what this is the stochastic histogram I'm pointing to right here. And all that does is it measures, the histogram is measuring the difference, or the distance, between this green plot and this red plot. And the red plot is what's called full D, and the green plot is what's called full K. Full K because full K is an average, and full D is an average of an average. So the slower one, so the average of the average is the slower one. I like to watch I kind of take my cues from full D, even if like, for example, here, full K is trading up. That to me is a bullish signal. Some people will take it as once that crosses down, like that's a bearish signal. That would be a real short-term bearish signal. I like to wait till the slower stochastic plot moves up above here before I consider it overall oversold. I don't know if I'm the only trader that does that. It certainly wasn't. I doubt it was an original thought. It's just my observations from having done this. That's what I'm most comfortable with, and that's the big thing with trading is, whether you're trading paper money or real money, over time you start to learn, you start to notice things, you start to notice patterns, you start to notice things that you think potentially could work for you. Sometimes that's why it's hard to trade a trading system. Like if you pay somebody for their trading system, it doesn't always work out because it's it's whoever developed it's optimized for whoever developed it usually. I don't know if it's necessarily optimized for just the average person to come in and start trading. That's why I think a better idea would be, instead of selling people a system, would be teach them how to develop their own system, which is what I want to do. So for example here, in this chart right here, which this isn't a time frame, 333 ticks refers to the number of trades that take place. So 330 transactions take place before a new bar gets drawn. So I want to wait till this is in kind of an oversold, both of them are in an oversold and turning up before I want to consider this a buy. And right now, given the fact that my stochastics, like I look at adjacent time frames, so in my 1 minute and my 4 minute, stochastics are now turning turning bearish. So I don't like to go against trends. If the trend is down, I don't want to buy. I want to ride the trend. You know how they say let the trend be your friend? That's what I'm doing here. Is I want to wait. So now that I think I see confirmation of price action to the downside, I want to wait till I'm overbought before I initiate a short position, if that makes any sense. And of course, if any of you have any comments, whether you're watching this live or if you're watching an archive of it, if you have questions, type them in the comments, right? And I'll do my best to answer them for you as a comment or in a future video. So again, you see here the fast stochastic, is what I'll call it for lack of a better term, cross below this 80 threshold. Some people might take that as a short. I'm not ready to do so yet because I don't know if it's going to cross this slower stochastic. I would rather wait, and usually I'm rewarded when I do this. I would rather wait until I see this crossover and indicate a downward move. Now I've also had times where in a shorter time frame I see that everything was up here in this overbought, and I look across time frames and everything's, let's say bullish or overbought itself. It seems like that opportunity to short just never comes because it's so bullish, because there's so much buying pressure that it just never happens. And we're kind of seeing that now. All of a sudden, this took a turn. Everything now turned up. A wave of buying pressure came in. So this short was not to be. Fortunately, I was a little slow on the draw there, so I missed it, but I missed the opportunity to lose money, which is good. Normally, the market doesn't like it when I miss opportunities to lose money, so what can I tell you? I'm sorry. So now it looks like this 243 period MA in the ticks is acting as support. If I see it break down below that, that might be a short signal, which it just did, but then it just ripped right back up. So since this really isn't acting as support or resistance one way or the other, now I'll turn my attention to this chart. I've got kind of tailwinds underneath this upward price action in terms of moving averages below it and moving averages turning upward. So for example, this 9 period, this is a 9 period moving average is turning up. The 27 period is turning up. It looks like 81 is turning up ever so slightly. That's the yellow plot right here. Obviously, the slower a moving average is, which means the more number of periods it's averaging over, the less rapidly it's going to change, its slope or its trajectory. And I've said this before, I like to, as I watch these charts, I like to think of it in terms of motion. It kind of helps me if I get a feel for the motion of the market, if I get a feel for, is it moving up, is it moving down, at what velocity is it moving up or down, is it in a holding pattern, when I see candles like this, it tells me like gravity is pulling it down. Not that gravity is really a concept in the stock market, but sometimes it helps to compare these things to other areas of life that you're familiar with, like gravity, for example. So what this looks like to me is an upward bias. We see an upward bias here. We see an upward bias in terms of curvature up here. The fast K is leading that. We definitely see an upward curvature here. So one of the things I like to do is kind of zoom out, maximize the sell, zoom out, and look at where we've been. So where we've been is, this was a great time to go long here because we were oversold from both perspectives. We traveled up. It looks like full D kind of touched, like it didn't really spend a lot, it didn't really cross over above 80. It just kind of technically, it's hard to read. I don't think it ever crossed really above 80. But it looks like because it didn't do that, like it's got pulled down here, but now it wants to tend back up here. So how they say like nature abhors a vacuum? I think that the stochastics abhor a situation where they haven't fully crossed up into either overbought or oversold before they make a definitive move up. So on this 1 minute time frame here, I really don't want to short it until full D crosses back up into oversold territory, overbought territory rather. Which would tell you that for now, if you want to take long positions, you might want to try making some money going long. Just if you're not good at scalping, when I say scalping, what I mean is like getting in and out of trades real quickly, like for a few ticks. Because sometimes if you stay in too long, you might have a profit, but because you kind of wore out your welcome, it turns against you and you lose it. And I've said this before, like let's say that I decide to go long and I think that my target is this 81 period moving average. Never mind the fact it traded above it. Let's just say that's my target. Let's say that you're right on the money and it trades right to that MA before it reverses and turns down. A lot of times when that happens, only a few contracts trade. So if 10 contracts trade at that level and you're number 11 in line, your order's number 11 in line, guess what? You don't get filled and you give back all your profits. So sometimes you might want to set your target a couple ticks in just to be sure that you get a fill. And even then, there's no guarantee you're going to get a fill. If it doesn't hit that level, you might not get filled at all. You might have to get out for a small loss. I've done that. It's happened to me a lot. So the AM edition of Traders Espresso, the video edition, is now processed, so it's accessible on my channel. And I'm going to post that to Facebook and LinkedIn and Twitter. In the description of this channel, and I think in the description of every video, if you want to follow me, like if you want to follow my Twitter, if you want to follow, connect with me on Facebook or LinkedIn, the links are there. I also publish articles and have a blog on Seeking Alpha. Seeking Alpha is a good resource. Just getting, if you like to read up on individual tickers and on the market, it's a good place to go. I'm not just saying that because I'm published there. I was a reader before I was a contributor. So early on, there's a lot of chop. This is very choppy. This is my Twitter feed for those of you who haven't seen it. Okay, everything's posted. So now we're seeing a decidedly bearish turn. And this tussle continues. the longer you go out in time frame, so like when you zoom out from a 15-minute chart to a 1-hour chart, or from a 1-hour chart to your 4-hour chart, or from your 4-hour chart to your day chart, you're getting some context. Going out, I mean even out to like a month, the monthly chart helps you get some context. Now granted, those are longer time frames. It takes longer for that picture to materialize. But for example, if I look at my 4-hour chart, what this tells me is this candle is forming a bearish stochastic crossover. So that means, at least right now, that tells me that the backdrop of the big picture is bearish. If I zoom in on the 1 hour, does it confirm that? Okay. Hard to tell. This was a bullish slope, and then it hits here, and all of a sudden a bearish tilt hits the market. Now it looks like, narrowing, but there might be something pulling price action down. If I look at my day chart, that tells me improving. Now, when your histogram is negative, when it's red, even if it's improving, keep in mind it's still bearish. Okay? Like you've got a bullish trend, right, but you still have something pulling down, still have something counteracting that. It can be a larger time frame. For example, the week, right? Look at this. More and more bearish stochastics. The monthly bar is forming a bearish stochastic. It's forming a bearish crossover. If you observe these things and you get a feel for how they, and it doesn't have to be this indicator, it can be any indicator, right? If you find one that you like, that you think seems to work with how you read things, and it seems to work with your way that you style, your style of how you trade the markets, then watch it, get a feel for it. If you feel like you've got a pretty good command of how it works and how to read the signals and when it's signaling a buy and when it's signaling a sell, if you have confidence in it, the more you trade with confidence, the more profitable you're going to be. It's that simple. Because if you get into a trade and all of a sudden there's a small move and, oh, I made the wrong decision, and you panic out of it, and you do that a lot, even if you're taking small losses, you're paying a lot in transaction costs. You got to pay attention to that. That's what makes trading futures so deceptively. Trading costs can be insidious. They can sneak up on you. So right now what I'm reading here is, yes, I still want to watch, I still want to see a crossover into overbought before I'm confident in a short. That's my supporting trend line right there. So if you see what this is doing right now, I've called this coiling. I don't know if that's a real term. That's what I call it. But it's basically trading back and forth here between a range that is becoming narrower and narrower. Price action is being contained. And eventually it's going to get a point, almost like a coiled spring, where it gets to an area where that coiling is so tight that it has to break out. So sometimes it will break out to the upside, sometimes it will break out to the downside. Usually it's with it, whichever trend line has been in place for the longest. That's usually the one that prevails. Now sometimes what it might do is it might just trade sideways. You can't really do a whole lot with that. And conceivably it might be trading sideways and now it's uncoiling. It doesn't have to be a dramatic thing, you know, like where it just uncoils like all of a sudden like a jack in the box jumping out. It can just uncoil slowly, and now it's trading into a broader and broader range. But everything has to be taken in context. There is no one pattern that you can draw. There is no one indicator that you can trade off of. You're always going to be looking for confirmation. So if I look at my stochastics, what my stochastics tell me here is that most likely the big picture is telling me that it's going to trade to the downside. Never mind that it's breaking support for a trend line that's been there in place for longer. That's just where the momentum is. Now another thing that you can look at is candles. If you're not familiar with candles or high-low bars, when your candle is green, and there's green, blue, and red here, so that might be a little bit confusing because I have a different study on this chart, but in general, when your candle's green, this is the open, this is the close, this is the high, and this is the low. Now there's no wick here, there's no shadow, so what it tells you is that the low and the open are the same number. It opened at that number and it traded up, it never traded below it. So in determining if there's a downward trend, you want to see lower highs, lower lows. You want to see that happening. Another thing is, a lot of times trend reversal can be signaled when you have a low point. Okay, so once your candles close, like this one just did, closed above the high of your lowest low, the candle that contains the high of the lowest low, that's a buy signal. It's not always a very durable buy signal, especially when you're dealing with such a short time frame. That's where other confirming signals can help. So in a case like this where you've got very choppy price action and it just keeps, and your stochastics keep telling you a different story, this is very active trading. So a good spot may be to try shorting once it hits this with kind of a tight stop. So let me try doing that here. See what happened there? So I just did that. That just worked for me for a quick $125 profit. The reason why I say you want to have a tight stop is that you're not always necessarily going to, sometimes it will. I mean, it'll trade right up to that trend line in reverse. Sometimes it'll trade a couple ticks over. You know, if you want to, setting stops is kind of a science and an art to it. You know, if you look at ATR here, which is average true range, average true range is basically like, in terms of points, okay, how much is it trading up and down? The higher that plot goes, the more room you have to allow it. If you set your stops too tight, you're going to get stopped out at a loss all the time. And your small losses are going to turn into a bunch of turn into a cumulative big loss, and on top of that, you're also going to have a lot of transaction costs because you're going to get into the trade, and then you're going to get stopped out. And a lot of times, if you set your stop too tight, and I've complained about this before. If you've been watching my streams, you know this. You know, as soon as you get stopped out, oh, that's when it rips in the other direction. If only I had set my stop, you know, maybe given it a couple extra ticks or 3 extra ticks, you know, I wouldn't have gotten stopped out. Where you set your stop, though, also has to be the amount of risk that you're comfortable taking. You take a look at it, it's a risk reward. Basically, you're calculating risk reward. Am I comfortable taking $100 of risk to make 400 bucks? Like I am, like $400, yeah. If I think, you know, I don't like taking one-to-one risk to reward, because if something's a coin flip, like with transaction costs, that's a loser. But, you know, if something's a coin flip and but my risk reward is 4-to-1, you know, you can see, if you know anything about statistics, over time, if you take that trade consistently every time, you're going to win. It's like flipping a coin, you know. If you could flip a coin, it's 50-50 odds, right? That it's going to be heads or tails. That's the law of independent trials. But when you're right, you're going to make $1. But when you're wrong, you're going to lose a quarter. I'll take that bet all day long, because eventually I'm going to come out in the long run. So I don't know if that makes any sense. I haven't looked at my P&L for the day in about half an hour. Good, I'm back to positive. Barely, but I'm back to positive. that small S&P futures trade helped. I'm going to buy back this short call, or I'm looking at buying back this short call, locking in this profit here, especially if I think the Autodesk is going to rip higher, either later in the day or tomorrow. This is not a high conviction market. There's a lot of volatility. And I was reading about that this morning. A lot of banks with trading desks. This volatility will be good for them because there really wasn't a lot of action other than everything's moving to the upside. So they weren't trading much. If they weren't trading much, then they weren't really collecting commissions. So this return to volatility could be good for the banks. I know I've cautioned against financial services. That was a technical call more than it was a fundamental call. I'm cautioning against investing in financial services for the same reason I'm cautioning against, information technology or consumer discretionary or healthcare, because I don't think that they've completed a healthy sell-off yet before they're going to rebound to the upside. Now, I also was looking at some studies. I looked at ATR, which is average true range. ATR is a measure of volatility, so how wide those price swings are. I was also looking at correlation, and specifically I was looking at what is the correlation between the S&P 500 index, so that's the SPX, and VIX, which is a volatility measure of 30-day call options on that index. And all things being equal, or normally the correlation is negative. Maybe not -1 exactly, but it's usually somewhere between 0 and 1, -1. One of the things that I found, and I'm still kind of studying this, and I'm gonna write a paper to publish on Seeking Alpha here pretty soon, is that when correlation goes positive between volatility and the S&P, it's eventually followed by price declines. Not immediately, because there's still a lot of volatility, because keep in mind, or I should be more specific about that, when correlation crosses over into positive and it's followed by, even if it crosses back into negative, if it's followed by increasing average true range, that's usually longer term bearish for prices. We saw it in the stock correction of 2007 and 2008, and there's a lot of other periods in history where that holds true. So, and the reason why that's relevant is we are in a situation right now where correlation crossed above 0. Right here, correlation crossed above 0, and even after it crossed below 0, it was followed by an increase in average true range. Now, just because we're seeing a crook here down doesn't mean it's done moving. It doesn't mean that at all. So here, this is 2007. We saw a big spike, correlation turned positive, and even though it turned negative, so prices and VIX were moving in opposite directions. That's what negative correlation means. ATR continued to increase, and as ATR continued to increase, that was long-term bearish for prices. Until average true range started to normalize, then it was able to rebound and start to leg higher. So why is this relevant? Well, like I said, we just saw this happen within the last couple of weeks, and ATR is increasing. I don't believe ATR is done increasing. I don't think volatility is going anywhere. And we may see some corrections, and everybody's taking a... Traders are so used to buying the dip that they're looking for confirmation that buy the dip isn't dead yet. Okay? I think eventually it's going to be sell the rip. It's going to be selling into strength. So that's what I'm working on. I'm sure that was probably more detail than you wanted, but so here we may have another opportunity to short. I think I missed it. That's okay, because I was looking at the stochastics and they made me a little nervous. And right now it's looking like I didn't really have a reason to be nervous. That nervousness was unfounded. It just looking at them, I was concerned about this may be point where it breaks through. But we haven't really gotten to that point yet where it doesn't always come to this. What I mean is that it doesn't always come to that pressure point before it breaks one way or the other. And in fact, one of the things I've observed is if it does come to that, then usually all it does is it kind of moves sideways, so you don't really get that break up or down. This Facebook spread is helping a little bit, not a lot. It wasn't yesterday because things were so bullish yesterday. But that's a bearish spread on Facebook. I'll show you why in a second. I took that one on. And see, now we're seeing it. We're seeing this break up and above. So this might be a spot to buy if I see a pullback here. A little bit of a pullback. Move my stop in if it will. There we go. That was nice. keep in mind that past resistance can be future support. So it can always trade back down here and kind of just ride this line down without crossing back into it. Now what's going to happen is, and those of you who are quick may know where I'm going with this, when you get here now you've got another decision to make. What's that oval? Alright, whatever. If it's going to bounce here, then in order for it to not now start trading up like this, it's going to have to break down. Now, whether or not you think that's going to happen is going to depend upon what the stochastics are showing you at that time, or whatever indicator you like to use. So you can see what I'm saying. It can trade kind of hugging this line, but then when it gets here, it's either going to now start doing this, which is likely because that is the longer term trend line, or it can just break through, and then it's going to have another decision point here. So that's why when you draw trend lines, once they're violated, I think it's still a good idea to leave them on your chart for a while, because past resistance becomes future support, past support becomes future resistance. Right now, what it looks like to me, because as you're trading markets or as you're watching markets, if you're observing, you want to know three things. You want to be able to answer three questions. What is the market doing? What is it trying to do? And how good a job is it doing getting there? Right now, what is the market doing? Well, it just broke through this trend line. It looks like it's headed higher. What is it trying to do? It looks like it's trying to trade up to this point of control. How good a job is it doing of getting there? Right now, it's doing an okay job. I mean, how do I judge that? By looking at my stochastics again. My stochastic histogram tells me that, across time frames, we're looking like pretty bullish here. So if I decide that I want to switch from scalping mode to just trading mode, I might wait for a little bit of a pullback, maybe down to about here, before I initiate another long position and ride it up here. So I have a primary and secondary trend line support. So a pullback here would be buyable. But I don't know, because I'm seeing this. So now it looks like it's a short. Now by that I don't mean take a short, because here's the problem. Resistance here, we got all this resistance here. Keep in mind that moving averages also follow that rule of past resistance becomes future support. These were resistance until they were violated. Now they've become support. These are almost operating as like tailwinds. So there's a lot of clutter that you got to get through. Like you want to see, like, bias to the upside has a lot more clear blue sky than this does down here. It would be like if you had the difference between you're in a high-speed car chase, are you going to drive down an alley that's empty, or are you going to drive down an alley that has a bunch of dumpsters in your way? You've got more obstacles. Not that I've ever been in a high-speed chase before with the cops, but I think it's a good analogy. And that doesn't mean it can't clear through here. It could. Again, what is the big picture? What is the market trying to do? What are buyers and sellers trying to do? What are bulls and bears trying to do? Right now, how good a job are the bears doing pushing this down? How good a job are the bulls doing holding the line? Checking in on our numbers, Dow Jones down 35 basis points. The NDX is actually positive, barely. It's up, decimal points. I mean, it's up 1 basis point, which basically that's flat. The composite's down 4 basis points. The S&P, different story, down 33 basis points. The RUT's down 28 basis points. The 10-year Treasury index is down. VIX is up. All futures are down, except for VIX futures, which are up. Futures on the 10-year note are also up. Gold futures are up. Not a whole lot though. I think that's off of its highs of the day. So what is it? So how good a job is it doing getting there? Well, now it's not. It's doing a pretty poor job of getting to that POC. Now it looks like it's trying to trade down towards here, bottom of this trend line, or bottom of this. So this, I haven't talked about this yet today. This rectangle, this gray area, this is the value area. When you run a profile study, which either volume profile study or time profile study, The value area is where, and it depends on how you define it, it can be 80% or 70%. The value area is where that particular symbol has traded, has spent 80% of its either time or volume. Now, because this is from yesterday's numbers, this is not developing. This is what happened yesterday. So this gray area represents where the S&P spent 80% of its time. Or sorry, no, it is time. And I think this is a good place to short because we've cleared the dumpsters, so to speak. Oh, I traded that. I didn't do a bracketed order on that. I didn't put a stop in. I'll have to do that here to protect myself. I might put a profit target here. It's also a good idea to tighten your stops. If it starts moving in your favor, so that was basically kind of a squeeze play where I was tightening my stops, and I could see it looked like momentum was starting to weaken. So I started bringing my profit target in a little bit. So I got out of that for a small gain. Right, I was going to show you Facebook and why I thought that was a short. I'll be right back, folks. I'm going to top up my coffee, and I'll show you Facebook. All right, folks. Boy, did that take long enough? I think you can already start to see why I view Facebook as a short because of the stochastics here across the week and the month time frame. Now granted, this is still forming, but this has been oversold for so long. I think we know what direction it's headed. This is leading it down. This is the week, this is the month. This is the price channel that Facebook has been trading in since about October 2013. With a few, minor exceptions, but it's always closed in this channel. Okay, it may have traded out, and if you can use the shadows as your reference points as long as you're consistent. So you don't want to use a shadow here and a closing price here, or use a shadow here, but then closing price on this side. You want to be consistent. And another thing that can affect it is whether or not you're using log or an arithmetic scale. Log basically adjusts for higher prices, so it's more like a percentage. Like if this was a log scale, these prices would be pushed together. Although it really was not noticeable. Did that log scale even take? Hold on. No, it did. Okay, whatever. So in this case, I need to adjust. Because I do prefer arithmetic over log scale. Sometimes it's not possible to be perfect. So you got to do like a best fit, which I think this is. So effectively, I mean, Facebook, like, the NASDAQ, blew out of its price channel here and traded up. And now it's coming back down again. And these two high points are forming a trend line, which is a point of resistance. So if I switch to my day chart, I also drew a point of a resistance line here because it acted as resistance here, acted as support here. So I think it will be support here somewhere, probably right about here. Because that's where the upper bound of the price channel and the resistance line as well as the downward trend line all kind of converge. So I think this is a key area. Now it could conceivably break through. It just depends on what's happened. Like I gotta look at the stochastics at that time, right? But if this trades down to this 162.70 level, okay. Then at expiration, I'd see a $600 profit at expiration, which is May. I don't know if it needs that long to get down there, quite honestly. As long as it's below 165 at expiration, I'm in good shape. Which is right around here where my cursor is. That's about 2 to 1, maybe a little bit less than 2 to 1, like 3 to 2. Profit to or reward to risk. But I also look at it from the standpoint of if I'm going to set a stop, where would I set it to stop me out? Like I know what my profit target is. Where would I set it to stop me out? Like how do I know I'm wrong? And that area would be probably right about here. So about the 177.50, 178 level. Or if I even go a little bit more aggressive and say, okay, I'll give it to 180, because that coincides with these two moving averages. So if it turns against me and it does trade up to 180, assuming that this is like, you know, that would be right here. Kind of like max loss occurs above 175. So that's kind of my Facebook trade. Not kind of, that is my Facebook trade. Now as volatility comes out of it, once I hit this crossover point here, volatility decreasing helps me. And that's one thing, if you're going to trade options, because this is an option structure, I basically bought a put spread. If volatility increases, actually I said that wrong. If volatility increases, I think that will help me. Because I'm long, this is overall a long position. But it's not making an adjustment. It's very slow. Yeah, volatility helps. Now it's not moving a whole lot because there's still a lot of time value left in this option. As time deteriorates, so let's fast forward to April expiration. It's going to help. Time decays exponentially the closer that you get to expiration. So when you get like here to the 14th, you can see and what is volatility on Facebook doing? Right now it's declining. So there you have it. So things are moving in my favor. Apple's down now, or Apple's up rather, because it's helping this Apple call. It's up almost $1. Autodesk has come off of its lows. And then of course we have we did 3 trades in the S&P futures that were profit of 125, 75, and 37.50. And average true range is kind of peaked out. So now it looks like the S&P is kind of between here and here. It's between these 2 trend lines, right? It's got moving average tailwind. It's back to moving up towards the point of control. now it looks like things are just kind of slow. Maybe we could take a look at what's happening in other futures markets. So overall, Australian dollar is up. British pound is up 40 basis points. The euro's up 60 basis points. The yen's up 1.1%. That's one to look at. Because the yen is considered a flight to safety along with the Swiss franc and gold. In the past, I've used the yen to play downturns in the market. I've used gold. I've used the Swiss franc with pretty good success. You know, for example, when, and this may seem counterintuitive, when North Korea fired that first missile over the Japanese island, over the northern tip of Japan, the yen rallied. People would have thought, why wouldn't that cause the yen to go down? Well, because the yen is considered kind of a flight to safety because it's been a, you know, Japan has had such low interest rates, you know, that it's considered a safe harbor. The other safe haven gold is up. Copper is up. And these are all the indices. So NASDAQ, the Russell, the Dow are down. The 10-year note, 10-year Treasury futures are up barely. This is the S&P. So copper, I think, is one to watch because copper is basically considered like a barometer for the health of the global economy. As traders are concerned about the impact that growth in the U.S. is going to lead to higher interest rates, which the fear is that will derail the stock market rally. You know, copper is a good commodity to watch. Commodities in general, but copper in particular, because also as commodity prices go up, that's inflationary. So copper has now fallen into kind of this long-term price channel. Now this is probably a bear flag. Because it came, this is usually a continuation signal. So it was on a downtrend, it fell into this price channel, trend seemed to reverse, it's now flagging up. It's going to come out, if it holds this pattern, it's going to come out and it's going to trade to the downside. Now if this were the opposite, and it traded up into this channel moving down will break out and continue that run higher. This is the negative of the copper futures. How do I know that? Well, because I have a chart of common patterns. Classic chart patterns. Let's see, I think bear and bull flag are on here. they don't have it on here. Let me find it. Here's an example of the bull flag. So you can see prices trending higher. It hits a channel where it declines and then it breaks out. Not that those other chart patterns would be invalid, but this doesn't look like it's wedging, or it doesn't look like it's a pennant. It's basically a right. It's basically it's trading in a rectangle, but it's at a slant down. But we're not dealing with a bull flag on copper. We're dealing with a potential bear flag on copper, which is important to know. Of course, it's only a 15-minute chart. See, that would look more like a bullish pennant. What would it mean to do that? Where it's rising up and it's kind of bouncing. You've got a rising bottom trend line and you have a downward sloping upper trend line. This one here is steeper than what we're seeing in this diagram, but that's okay. This could also be considered a symmetrical triangle. Just because of the angles seem complementary. I don't think futures will display, or I don't think these will display on a futures. At least that's how it used to be. No. But they will on a stock. So if we pick a stock that's a proxy for copper, so Freeport-McMoRan, oh, there they are. That's a lot of patterns, but like looking at this one here. Okay, this one in particular is a rising wedge. Rising wedges are generally bearish. Oh, no, I can't say that. Rising wedges, as we saw, are neutral. Am I right about that? No, that was right. Rising wedges are bearish. And you hover over the chart and it will tell you like where the price action is likely to go. And it was right. Now these aren't always right. That happened to be right. So let's experiment. What, if any, does Facebook have? Doesn't appear to be displaying any. So patterns, if you can spot them, can be helpful. If you have charting software that does it for you, that's certainly very helpful. I don't know how helpful that is. Another thing that can be helpful, like for me, I have certain futures I follow, like the Australian dollar, the British pound, etc. I like to see what patterns I can spot. So if I just start with a clean slate here, what does that look like? It looks like a bear flag. So anyway, that's enough of that. It's 9:29, so lunch is just about to start on the East Coast. So let's take a quick check of where we are, and then we'll break for lunch. Dow Jones is down 108 points. NDX is down 7 points. The Nasdaq Composite is down 8 points. S&P is down 8.6. RUT's down 3.2. Index on the 10-year Treasury is down half a percent. VIX is up, though off of the highs of the day. VIX futures are up, though near the highs of the day, it looks like. Dow futures, Nasdaq 100 futures, S&P futures, Russell futures all down. Down by a greater percentage, it looks like, than their cash counterparts. Not a whole lot. dollar's down and is declining because that 63 basis points was lower. That was better before. So that's kind of where we sit. So have a great lunch, everybody. See you around 1:30 Eastern Time.